Welcome back, everyone. Today, we're diving into a highly focused explainer covering the newly released FY26 annual report and quarterly results from Balaji Amines. Now, if you've ever actually tried to read through one of these dense, hundreds of pages long chemical manufacturing reports, well, you already know it's basically a maze. It's full of jargon, massive numbers, and complex molecules that make you feel like you need a PhD just to parse a single page. But don't worry, that's exactly why we're here. Our goal today is to cut right through all that noise and get straight to the core of how this company is actually performing under the hood. Okay, let's dive into this because look, at the end of the day, as a shareholder or even just a prospective investor, you really only have one central question, right? What do these numbers actually mean for your portfolio? Balaji Amines has been navigating a pretty turbulent global chemical environment lately, but as you're about to see, they're aggressively positioning themselves not just to survive, but for total structural dominance. We're going to break down the tangible financial impacts right now and look at the massive groundwork they're laying down for the coming years. So, here is our roadmap for this explainer. First, the FY26 shareholder payout. Second, the metrics behind the molecules. Third, building India's chemical future. Fourth, navigating the global market. And finally, number 5, the road to FY28. All right, let's kick things off with Section 1, the FY26 shareholder payout, the bottom line. Looking directly at the financial impact on your wallet, the board of directors just declared a dividend of exactly 11 rupees per equity share for the 2025-2026 financial year. And listen, this isn't just some abstract accounting figure. We are talking about a direct cash outflow of over 3,500 lakh rupees going right back to the shareholders. And let's be honest here, who doesn't love actual cash dividends, especially in a year where global markets face some serious headwinds? This 11 rupee dividend is a highly tangible reward for your investment. It proves that despite economic friction out there, the company is generating the free cash flow needed to keep rewarding the people holding its stock. Now, what's really interesting about this slide is how the underlying profitability actually supports that payout. Just look at the earnings per share, the EPS. It bumped up from 49 rupees in FY25 to 52 rupees in FY26. Now, sure, that might seem like a modest step up at first glance, but context is literally everything here. The company explicitly noted that FY26 reflected their ability to navigate a very challenging global chemical environment. So growing your EPS to 52 rupees while keeping a totally debt-free balance sheet in this kind of macro environment, that is a rock-solid indicator of operational resilience. Okay, moving on to Section 2, metrics behind the molecule's operational drivers. So we know the payout was strong, but let's widen the lens a bit and look at the operational metrics that made it happen. The crucial point is this EBITDA margin right here. It expanded from 19% in FY25 to 20% in FY26. Now, I know what you're thinking, a 1% shift looks tiny on a chart. But in the massive scale of industrial chemical manufacturing, this 20% margin isn't just a number, it's an absolute victory in efficiency. It basically means that for every single rupee of revenue they generate, they're keeping more of it as core operating profit. It shows us that management is doing a stellar job controlling raw material costs and optimizing the way they manufacture. Let's move to and see how this builds into the immediate future. The annual results were solid, for sure, but take a look at these standalone numbers for the first quarter ending June 30, 2026, compared to that same quarter last year. The momentum here is honestly explosive. Revenue from operations leaped from roughly 31,900 lakhs all the way up to over 42,200 lakhs. But what's even more impressive? Profit before tax nearly doubled. It skyrocketed from about 5,200 lakhs to over 9,700 lakhs. For us as shareholders, this is a massive green flag. It tells us the financial engine isn't just, humming along. It is aggressively accelerating as we push further into the new fiscal year. Let's jump to Section 3, Building India's Chemical Future, Strategic CapEx. So how exactly are they generating this kind of accelerating profit? Well, we have to connect the numbers we just saw to actual physical assets. And this brilliantly illustrates the company's core philosophy. These images, pulled directly from their annual report, pair massive, highly complex chemical infrastructure with some incredibly strong India-first branding. Management noted that they saw a gap coming that others completely missed, that India's future growth was going to require far stronger domestic chemical capabilities just to stay resilient and self-sufficient. Basically, they're positioning Balaji Amines as the definitive solution to building what India needs before India even realizes it needs it. And listen, this isn't just some catchy marketing slogan. It's backed up by profound technical execution. Balaji Amines literally built India's first indigenous technology for manufacturing aliphatic amines. This is absolutely crucial for shareholders to grasp. This tech wasn't borrowed. It wasn't licensed from some massive foreign conglomerate. It was developed entirely in-house by their own scientists and engineers. By achieving this kind of technological self-determination, they've totally bypassed licensing fees and reliance on outside partners. They have effectively built a permanent, massive structural moat around their business. And right here is the actual physical manifestation of all that capital expenditure. This is their methylamines plant that was commissioned back in November 2024. It proves the company isn't just hoarding its cash. They are actively putting it to work, expanding their physical production footprint. These vast, tangible assets are what directly enable the volume growth that drives the revenue up. Think of it this way. Every single new plant they commission is basically a brand new engine for shareholder value. Moving right along to Section 4, Navigating the Global Market, Export Strength. A company operating at this kind of massive scale simply can't survive on domestic demand alone, right? When we break down the consolidated revenue split, we see that a very solid 14.30% is coming straight from international exports. And this is a highly strategic balance. It means they maintain this overwhelming domestic dominance, really capturing the rapid growth happening inside India, but they're also safely diversified. If local demand hits a speed bump, they've already got these established international channels ready to absorb their production capacity. But honestly, what's even more impressive is exactly where those exports are going. Over 36% of their total export revenue is coming straight out of Europe. The report also highlights their expanding reach into Japan. So why does this matter to you as an investor? Because Europe and Japan are notoriously strict, highly regulated, precision quality markets. The fact that Balaji Amines chemicals are being bought and accepted in these regions, that's the ultimate validation of their product quality. It proves they aren't just out there competing on cheap prices. They're competing and winning on absolute top-tier global quality standards. Which brings us to our final section, number 5, the road to FY28, forward guidance. As shareholders, we don't just buy a stock for what it did yesterday. We buy it for its future. And management has laid out some incredibly clear, very grounded projections here. For FY27, they're guiding for 10 to 15% consolidated volume growth, with those EBITDA margins pushing even higher into the 22 to 23% range. And looking out over the medium term, they're forecasting an aggressive 20 to 30% volume growth. Now, this isn't just blind corporate optimism. The report emphasizes that this growth is being driven by specific new plants manufacturing key specialty chemicals like DME, NMM, and ACN. This future revenue is already queued up, waiting to be unleashed by physical assets that are currently being commissioned. I want to anchor our whole analysis today with this powerful quote, straight from management. FY28 will be the year our shareholders begin to see the full revenue and margin impact of that preparation. They go on to say that the investments are already made, the plants are being commissioned, and the customers are lined up and ready. That is a profound statement of confidence. It's essentially telling shareholders, hey, the heavy lifting, that intense, expensive capital expenditure phase is largely behind us. The harvesting phase, that's about to begin. So, I'm going to leave you with this final thought to ponder as you review your own portfolio. The groundwork is laid. The technology is indigenous, the margins are actively expanding, and these massive new plants are coming online as we speak. How will the progressive contribution of these brand new assets shape Balaji Amines stock in the quarters to come? For sure, you're going to want to keep a very close eye on those volume growth metrics in the upcoming earnings calls. That is exactly where this story is going to unfold next. Thank you so much for joining me on this explainer. Keep learning, stay focused, and I'll catch you on the next one.